Imagine this for a moment. While most retail investors are panicking over headlines, inflation fears, interest rate uncertainty, and market volatility, the world's smartest money managers are quietly doing something very different. They're buying, not hype stocks, not social media fads, real companies with real cash flow, strong balance sheets, and long-term dominance. And today, we're breaking down exactly which stocks super investors are buying right now, why they're doing it, and what this means for everyday investors like you watching this video. When we talk about super investors, we're not talking about lucky traders. We're talking about legendary names and institutions that have beaten the market for decades. Warren Buffett, Berkshire Hathaway, Ray Dalio, Stanley Druckenmiller, big hedge funds, billion-dollar pension funds. These investors don't chase noise. They position themselves where growth, value, and resilience meet. And historically, following their footprints has been one of the smartest strategies in investing. Let's start with why now. The market has been through aggressive rate hikes, valuation resets, earnings slowdowns, and massive rotation. This environment scares most people away. But for super investors, this is where opportunity lives. Volatility is the price of admission for long-term wealth. When prices fall faster than fundamentals, that's when patient capital steps in. One of the most accumulated stocks by super investors lately is Apple. And no, this isn't just about brand loyalty. Apple is one of the most profitable companies in history. It has a cash machine business model, massive buybacks, growing services revenue, and an ecosystem that locks users in for decades. Institutional buyers see Apple not just as a tech stock, but as a consumer monopoly with incredible pricing power. Even when growth slows, Apple keeps generating absurd amounts of free cash flow, which gets returned to shareholders through dividends and buybacks. Another stock getting serious attention is Microsoft. This isn't just a software company anymore. Microsoft is deeply embedded in global business infrastructure. Office, Azure cloud computing, enterprise security, artificial intelligence, and gaming. Super investors love Microsoft because it benefits from long-term digital transformation trends. As companies move more data, operations, and AI workloads to the cloud, Microsoft continues to compound revenue with very high margins. When uncertainty rises, institutions rotate money into companies with predictable earnings, and Microsoft fits perfectly. Now let's talk about a stock that many retail investors fear but super investors love. Google, also known as Alphabet. Concerns about advertising cycles and AI competition have pressured the stock, but institutional investors see value. Google dominates global search, digital advertising, YouTube, and Android. Its balance sheet is rock solid, and it generates massive free cash flow. Super investors believe AI is not a threat but an opportunity for Google to strengthen its moat. At current valuations, many funds see Alphabet as undervalued relative to its growth potential. Amazon is another name showing up repeatedly in super investor portfolios. While profits took a hit during heavy investment periods, Amazon is now emerging leaner and more efficient. Cloud computing through AWS, logistics dominance, advertising growth inside its ecosystem, and unmatched scale make Amazon incredibly hard to compete with. Smart money understands Amazon sacrifices short-term profits for long-term dominance. When margins rebound, earnings can explode upward, which is exactly what long-term institutions position for. Now let's shift to the financial sector. J.P. Morgan Chase has been aggressively accumulated by large investors. In times of economic stress, the strongest banks get stronger. J.P. Morgan has fortress-level balance sheets, superior risk management, and scale advantages. When weaker banks struggle or exit the market, J.P. Morgan absorbs market share. Super investors see J.P. Morgan not just as a bank, but as a financial infrastructure giant that benefits from consolidation, rising interest income, and long-term economic growth. Another financial favorite is Berkshire Hathaway itself. Yes, super investors buy the investor. Berkshire is filled with cash-rich businesses, insurance float, and a massive equity portfolio. Investors see Berkshire as a defensive compounder that can deploy capital aggressively during market downturns. When chaos hits the market, Berkshire doesn't panic. It goes shopping, and investors want exposure to that strategy. Let's talk energy, because this is an area many retail investors underappreciate. ExxonMobil and Chevron are being accumulated by super investors despite the push toward renewables. Why? Because energy demand keeps growing globally, especially in emerging markets. These companies generate enormous cash flow, pay strong dividends, reduce debt, and buy back shares. Super investors don't invest emotionally. They look at supply-demand economics. And traditional energy still plays a massive role in the global economy for decades to come. Healthcare is another sector where smart money quietly positions itself. United Health Group is a favorite among institutions. Healthcare spending continues to rise regardless of economic cycles. United Health dominates insurance and healthcare services, with a data-driven model that improves efficiency and margins. Super investors love businesses with predictable demand, pricing power, and long-term secular growth, and healthcare fits that perfectly. Now here's where things get really interesting. Super investors are also buying semiconductor stocks. Nvidia gets most of the headlines, but institutions are also quietly accumulating companies like TSMC. Taiwan Semiconductor is critical to the global tech supply chain. It manufactures chips for Apple, Nvidia, AMD, and countless others. AI, data centers, electric vehicles, and advanced computing all rely on TSMC. Despite geopolitical concerns, super investors believe its technological lead makes it irreplaceable. Another semiconductor name drawing attention is AMD. While volatile in the short term, AMD continues to gain market share in CPUs and data centers. Institutional investors see long-term demand growth driven by cloud computing and AI workloads. These investors understand that short-term price movements don't matter if the business continues to improve its competitive position. Let's talk consumer brands. Coca-Cola remains a super investor favorite. This might surprise younger investors, but Coca-Cola has survived every economic cycle for over a century. Its distribution network is unmatched. Its brand recognition is global. And it consistently generates cash. During inflation, Coca-Cola raises prices. During recessions, people still buy beverages. That stability is incredibly attractive to large funds managing billions that need predictable returns. Costco is another stock that super investors continue to buy aggressively. Costco's business model is brilliant. Low margins, loyal customers, subscription membership fees, and massive purchasing power. During inflationary environments, consumers look for value, and Costco thrives. Institutional investors love the combination of growth, defensiveness, and customer trust. Let's not forget about the industrial sector. Companies like Lockheed Martin are on the radar of super investors due to rising global defense spending. Whether people like it or not, geopolitical tension drives defense budgets higher. Lockheed has long-term government contracts, predictable revenue streams, and strong cash flow. Institutions see defense stocks as a hedge against global instability. Now here's the most important lesson from all of this. Super investors don't buy because prices are going up tomorrow. They buy because value, fundamentals, and long-term trends are on their side. They're willing to look wrong in the short term to be right over decades. Retail investors often chase momentum. Super investors build positions slowly, quietly, and patiently. Another thing to understand is diversification with concentration. Super investors don't own hundreds of random stocks. They focus on high-conviction businesses and allocate capital accordingly. They think in terms of business ownership, not ticker symbols. If you're watching this and thinking, how can I invest like super investors? The answer is simple but not easy. Stop reacting to headlines. Start studying businesses. Focus on cash flow, balance sheets, competitive advantages, and long-term demand. Invest consistently. Think in years, not weeks. Also remember, super investors don't time the market perfectly. They scale in. They buy during uncertainty. They hold through volatility. And they let compounding do the heavy lifting. Most wealth is built slowly, then suddenly. Before you rush out to buy any stock mentioned in this video, always do your own research. Understand your risk tolerance. Not every super investor move fits every personal situation. But studying where smart money flows gives you a massive edge over emotional investing. If you want more videos breaking down what the world's smartest investors are doing right now, make sure to like this video, subscribe to the channel Stock Predictor, and turn on notifications. The biggest opportunities often appear when fear is highest, and those who stay informed and patient are the ones who win in the long run. Stay smart, stay disciplined, and I'll see you in the next video.